Hey everybody, knock knock, Derick Van Ness here, opening up the doors to another day, another year, and what I think is going to happen in 2021. If you don't already know, I'm a wealth strategist, investor, life adventurer, and I'm here to share my thoughts on where we are, the state of the economy, because I know there's a lot of things moving around, a lot of questions people have, but by the end of this video, you're going to know my thoughts on where's the economy going, what's going on with real estate, the stock market, what should you be doing, what could you be doing, what should you consider with debt, inflation, investments, cash, all of that kind of stuff. So sit down, grab a pen and paper. Love to get your comments down below if you have questions on what I'm about to say. But by the end of this, I think you're going to have a pretty good amalgamation of what's happening out there, because we have some really interesting and historic things going on as we leave 2020, come into 2021, and try to make sense of all of this madness that's already gone on. Hopefully 2021 won't be the dumpster fire that 2020 was for most of us, right? So let's just start out and say this. We're going through something that hasn't happened in recent history with the pandemic, and definitely with the level of government intervention. It's created all sorts of waves and ripples and insulation that we haven't typically seen in a market. So there's a lot of things to make sense of, okay? So the first thing is, of course, we had the pandemic and we had a lot of things happening in the spring and in the early summer that were really bad. We had record unemployment, we had tons of job losses, and then a lot of those jobs kind of came back and things started to stabilize in some areas, but in some areas they definitely didn't. So what does all that mean and how do we make sense of it? Let me start with something I know a lot of people that follow me and that I work with care about, and that's the real estate market, right? A lot of people are wondering what's going to happen there. And so we have some competing forces that are really, really interesting in the real estate market right now. Housing prices are going up, but so are delinquencies. That means like people who are behind on their mortgage has been going up. Usually that doesn't happen, because usually what happens is as people go into foreclosure or get behind on their mortgages, they sell their house, and that causes more houses to be on the market and brings the price down because there's more competition, there's more houses for sale. This year though, because of the pandemic, two major things have happened that are kind of countering that normal, actually three things. One is the government has put a moratorium on foreclosures, which means you can't foreclose and a bank can't foreclose and move somebody out of their house until January 31st as of the time that we're taping this. So that means a lot of people who normally would have been forced to sell their house and move haven't had to. So that's one reason there's less houses for sale. The second reason there's less houses for sale is a lot of people don't want to move during a pandemic. Who wants movers coming through and having to go look at houses and meet people and go to foreign places? Like, a lot of people just haven't known what's going on with it, and so they've deferred and delayed moving or putting their house up for sale. Even if they'd like to, a lot of people are staying put, right? So there's less houses for sale there. And then on the flip side, interest rates are at an all-time low. The Federal Reserve has lowered their rate, which Federal Reserve is the organization that lends money to banks. So the cheaper they lend it to banks, the cheaper that banks can lend it to you. So the Federal Reserve is currently at 0%, which we haven't really seen. And I think they're really hesitant to go into negative interest rates for a number of reasons that we won't discuss in this video. But the bottom line about that is interest rates are at an all-time low. And so that means your $2,000 a month payment buys more of a house. It used to buy a $400,000 house. Now it buys a $450,000 house, so you can afford to pay more for a house. Housing prices are driven by the monthly payment. The monthly payment is determined by interest rates. So interest rates being lower means more people can buy bigger houses or pay more for houses. So that's pushing the price up. So we have less houses for sale and we have cheaper money, which is pushing that up. And then foreclosures, which would normally counter some of that if the market goes too high and people can't afford their houses, has been taken out of the equation by the government. So what does that mean? What that means is at some point there's going to likely be a day of reckoning. And that day of reckoning is all these people who are going into foreclosure, right? And banks have been working with them and everything, but they've been going into foreclosure. A lot of them have been able to recover. Like, a lot of people went into what was called forbearance, right? And that forbearance means, let's say they couldn't make their payment in April and May because they were out of work, but then they went back in June. The bank will say, hey, we'll take your payment that you owe, the money you owe where you're behind for 2 months, will push that to the back of the loan and you'll just pick up making payments normally. So as you start to do that, people went into forbearance and were starting to make their normal payment. But even in that group, about 25%, 25 to 30% of that group has not been able to even make the normal payments. So what we see there is there's a group that, even though the banks are working with them, still isn't able to keep up on their mortgage. Now, the good side to that is another 25 to 30% of those people have actually been able to make up the payments now that they're back to work and they're doing well. But what we're seeing is there's that one group that can't catch up and they can't be kicked out of their home. And so they're building up. There's all these people who really just can't afford to be in their home anymore, but still are. And if they don't change the deadline, January 31st, those people can all be foreclosed upon. The significant thing is here, and this has never happened before to my knowledge, is that all of those people will be getting foreclosed upon at the same time. So that could potentially lead to a bunch of bank repossessions and a bunch of houses going on the market at the same time. Now, banks aren't stupid. They're not going to put everything on the market at the same time. They're going to feed that out over time so that they don't end up having to sell their house and compete against all their other foreclosure houses. But the reality is we've never seen a flood of people come all at the same time because it's been backed up for 9, 10, 11 months. Now, the question is going to be, as those houses go up for sale, the ones that have been foreclosed upon, are those going to be, is there going to be enough buyers to snap those up? Right now we have way more buyers than we have sellers, but at that point that might level a little bit. Or if we have too many foreclosures, we could see that the prices are going to start to come down because there's not as many buyers and there's too many sellers now. And if that starts to happen, that's where we could see a correction. And what happens with these corrections is once there's too many houses for sale, let's say there's 10% more houses for sale than there are buyers, prices don't just drop 10% because everybody's trying to undercut the other guy and trying to sell their house quickly. And people who need to sell can't sell as fast, so they get into bigger trouble. And people don't have as much equity if they bought in the last year or two. And so now when they go to sell, they can't get rid of their house because the value's gone down. And it creates this ripple effect that can go down. And this is kind of what happened in 2007, 8, and 9, was there was just way more sellers than buyers. And even though the balance wasn't as big as it could have been, it was enough that the sellers had to really compete for business. And that really drove prices down in many cases, 30, 40% drops. What remains to be seen and what we're not sure about is how many buyers are out there and how is this flood of foreclosures that could potentially come out going to be absorbed. It could be that we have a nice equilibrium and we're fine. It could be that the market holds up great, or it could be that we end up with some sort of correction, and that remains to be seen. A little bit later in this video, I'm going to tell you my thoughts on what I think will happen. By the way, while we're taking a quick break here, I just want to say if you're enjoying this video, if you find this valuable, please hit the like button or smash it if that's something you're into. You can even use your elbow, just don't hit your computer too hard. And that really helps us with the YouTube algorithm, helps us to get out to more people and share this information. So if you're enjoying this, I'd love that. Also, if you're not a subscriber, hit the subscribe button, join us. I'd love for you to continue to get this information. I try to keep you up to date on as many things as I can and share tips and tricks that will make a massive difference for you financially in all kinds of different financial topics. Anyway, so coming back to real estate we're at a tipping point with real estate. We're going to see in the next couple of months here how many foreclosures happen. So I would keep an eye on that, especially if you're a real estate investor, and kind of understand what's happening in your market because it may be somewhat market sensitive, right? Okay, so another question that a lot of people have is what's going on with the market? We had a crash in March, then we had a huge recovery through the spring and summer. Now things have kind of been recovering slowly, but then we've had some down weeks and up weeks. So we're kind of at a flatter time here at the end of the year. So what's fueling all that? What's going on? And how do we make sense of this? So there's a couple of things. One is that we have the haves and the have-nots in the stock market. We also have them in the economy. Essentially, there's a bunch of businesses, tech-related businesses like Amazon, Google, Microsoft, Apple have done super well during the pandemic. Netflix, right? Everybody's watching stuff on TV. And then there's a bunch of businesses that are, hotel businesses, travel businesses, cruises, airlines, these kinds of businesses that have been decimated because those are the types of things that people can't partake in right now, right? And so a lot of people have talked about what we call a K-shaped recovery, meaning that a part of the economy is going like this, which is great, but if you're in the wrong part of the economy, it's going like this for you, right? It's going down and it creates a K. Depending on what industry you're in, it can make a massive difference on what your circumstances look like right now. And so how that impacts the stock market is this: there's been some downs, but there's been some ups to kind of offset that. But also a huge thing is, once again, government intervention. If you didn't know this, back in April, when they rolled out the CARES Act and everybody got their stimulus check, and there was also PPP loans to help protect payroll so that businesses could stay open, and then also a lot of SBA and EIDL loans that businesses got that infused them with a ton of cash. Literally in April, more money went into savings accounts than normally goes in an entire year, or has ever gone in an entire year. So that's how much money got pumped into the economy. Well, guess where a ton of that went? A ton of it did go into the stock market. In fact, what I read was the number one use for a stimulus check was to put it in the market, because the market had crashed and a ton of people were like, hey, I'm gonna buy low. So a ton of people went into that. A ton of people sat home and day traded. They joined apps like Robinhood and some of these other things. And so a lot of money started going into the stock market to help that recovery, right? And so that really helped a lot of people recover. It put a ton of new money into the market, and we've seen the results of that. Also, people have been doing home improvements and a lot of other things in the good part of that K-shaped recovery. A lot of people have been spending their money there to kind of keep those companies strong. So that's been great. So what do I expect to happen? We've kind of had this up and down, this flattening that's been going on for the last couple of months. We just passed another stimulus bill. It sounds like they're going to do $2,000 checks instead of $600 checks, but no matter what the government does, a ton more money is coming into the American public's pockets. My guess is a lot of that is going to go into investments and putting it into the stock market and growing the money. So, and buying goods and services that fuel those companies' profits so they can continue to rise. So my guess is that we're going to see the stock market probably remain strong for a while, even though it's being artificially propped up by the government. So this is really important, and when we get to my thoughts on what's going to happen here, I'll talk to you a little more about that. But right now, a ton of money is being pumped into the economy, and so that's keeping a lot of things bolstered and strong, and I know that's the government's idea, is for things to always go up and never go down. But let's be honest, that's not sustainable. We've never seen it happen. There comes a point where you sort of have to come back to reality, and so it's likely that we'll see that happening. When and how remains to be seen, and some of that's going to depend on government intervention. Do they do more stimulus? I don't think people expect that, but we just passed one. Maybe now people will start looking for the next one. I'm not sure, right? So we're going to see what happens with that. But that's what I think is going to happen with the stock market, is we're probably going to see a ton of money going back into those types of assets and continuing to grow, because last year ended up being a decent year, and depending on where you were invested, maybe even a very good year for the stock market. So a lot of people are excited about that, and they feel like, hey, we already took our bump because of the pandemic. Let's ride this for the next 5, 6, 7, 8, 10 years and see where it goes. So let's talk about small businesses real quick. We know that it sounds like 1 in 6 is the statistic I keep reading. Small businesses has closed their doors and is never going to be opening them again. So what does that mean? That means there's a ton of people out there who don't have work. Now, there's good and there's bad to this, and I'll talk about this a little bit later, but the downside is we have a lot of people who are unemployed, who are looking for jobs, who are trying to make ends meet, and that's really, really rough. They're on the bad part of the K-shaped recovery. The good part is, if you're on the good part of the K-shaped recovery as a business owner, who I primarily work with, but in general, is there's going to be a lot of good people out there that you can hire and bring into your business who normally wouldn't be looking for work, but right now they need a job, and you can get them affordably and get good talent to come to your company. So I think that's a huge opportunity for the future. But the reality is we're seeing a restructuring happening, and I know this isn't news to you, but a lot of jobs are changing, and a lot of jobs have gone away that are never coming back. And so being smart about how you want to build your business moving forward, build your career moving forward, the skills that you want to acquire moving forward and what you want to become very good at is going to be vital in determining how successful you become moving forward with your business and your career, right? So if you're in one of those places where you're looking for work, I would look to acquire skills that are going to allow you to move up in fields that are going to continue to do well into the future, not things that are anchored to the past so much, because a lot of the old way, it's just not coming back. Like in 2010, 2011, I remember mortgage brokers saying, oh, I can't wait till we can go back to the good old days when we had no doc loans and nobody had to qualify. You basically check someone's pulse and you give them a loan and you make a bunch of money, right? The guys who were waiting around for that to happen, it never happened. And so those people sat around forever waiting for the good old days to come back that never will. If you're looking and waiting for the good old days, I got news for you. They're probably not coming back. So much of what's been going on right now and the changes that have happened because of the pandemic are gonna stick. Businesses that have closed their doors, many of them won't open back up. Businesses that have sent a lot of employees home to work from home, they're not bringing employees back, so those offices are going to sit vacant eventually. Those businesses are going to downsize those offices, and those changes will become permanent, which is not a problem at all. It's just if you're counting on people coming back to office space or coming back to the way that things used to be, your business might be in trouble. So I think it's really, really important to grapple with that and realize a lot of the changes that have happened are permanent, and a lot of the changes that took place jobs aren't coming back, and it's okay, but sometimes that's painful if you're in the middle of it. So the last thing that I want to tackle here before I kind of get into my thoughts is inflation. A lot of people, especially earlier this year when the Fed lowered rates to 0, were concerned, what does inflation mean? And I just want to give you a quick summary of my thoughts on inflation. So for some people, inflation might be bad, right? Inflation generally means your dollars are worth less, so stuff costs more dollars. And the reason that happens is we just pumped basically $4 trillion into the economy, 4 or 5 trillion. That's a lot of extra dollars that are floating around. So each dollar is worth a little less because there's more of them, right? So how does that impact you? A couple of things. One is if you own cash and you just have a bunch of cash sitting in a bank account, your dollars are going to be worth less. That's going to hurt you. But if you own assets, if you own real estate, if you own stocks, if you have money in things that pay dividends and can adjust based on their profitability, like life insurance, properly structured and everything, or other kinds of equity, gold. I mean, I've seen some crazy numbers in Bitcoin lately. I'm not saying you should do any of these things, but those types of assets are going up. They're going to adjust for the dollars, right? So assets are good, cash, not so good. I'm going to tell you about my thoughts on how you should balance that in just a sec here. But that's going to be a major factor. But here's the flip side to that. If you have debt, if you have a house payment, your house payment will remain the same, even though the dollars are worth less. So your house will effectively get cheaper. If you have a bunch of student loan debt, if you have a bunch of other debt that's fixed rate debt, chances are really good that your debt's going to be cheaper than it was, and that could be a real relief for you. In fact, I have it in my belief system that the government actually wants some inflation to happen so that the debt that we've all incurred with this $5 trillion of stimulus, I got news for you, it's not free, it has to get paid back. To get that paid back, they want more dollars out there because then when they pay the debt back, it's cheaper, right? Because the dollars are worth less. So that's something that I believe is kind of on the horizon and we're probably going to see. I don't want you to be afraid of inflation, and I'm going to tell you in just a sec with my predictions how I think you can navigate that. But essentially this, if you have adjustable rate debt and you think it might go up, you should probably put it into fixed rate debt. If you've got a ton of money in cash, ideally look for and talk to an advisor about assets that are available that you might be able to put that in to help mitigate any of that. If you own assets, that's great. Your value will go up. If you own real estate, your value will go up and your mortgage payment will stay the same, but it'll effectively get cheaper. So there's a lot of good things that can come out of inflation. I say all that to say that as long as you're not sitting in cash or bonds, inflation probably isn't going to be a super scary thing for you. Okay, so let's talk about my thoughts on what might happen in 2021. These are my thoughts. This is for entertainment purposes. This is not advice, but I just want to share what I'm thinking here. First thing is, I think the best thing you can do is be really good at your job and continue to get better because you will adjust for inflation, and the best way to make money is be really good at your job, okay? So having said that, or being really good at your business, that should be your number one focus in my opinion. All that other stuff you can't control so well, that's one thing you definitely can control. Second thing is, I think you should have 3 to 6 months worth of cash reserves, but over and above that, I think that you should probably put your money into some sort of assets that will adjust for inflation in case we see inflation happening, okay? So I would look at that. That could be a lot of different things. I'm a big advocate of putting your money into things you know about, things you care about, and things you control. I got other videos on all of that. I think the real estate market, we're probably going to see, because of the moratorium and because banks aren't dumb, I think we're going to probably remain strong. Interest rates are going to remain low, is what we've been told, probably at least until the fall of 2021, because even if banks are taking a lot of property back, they're going to siphon those out over time. There is a lot of buyer demand built up, and I do think that buyers are going to end up scooping up a lot of those properties as they become available. And we're going to have to see a little bit of equilibrium. So I would say through spring and summer, probably into fall, at least we'll see strong real estate. I think the stock market, the same thing, because of the stimulus checks and because of a lot of the government intervention. I think we're going to see the stock market remain pretty strong through Q1 and Q2. After that, I'm not so sure. It depends. If the government continues to do things to bolster small businesses, maybe we'll stay there. But I personally believe that a lot of stocks are overinflated. A lot of values are higher than they should be. A lot of companies that should have failed and gone out of business but haven't yet, they're going to fail and go out of business. So we're going to have a little bit of house cleaning happening there, a little bit of reality check. I do think we'll see some sort of correction probably in the second half of 2021, maybe 2022. So don't be fooled by the bubble that's being created by the government with all this stimulus. That's not actual productivity out there happening. That's just a bunch of money being shoved into the system to hopefully keep us from just going down a terrible rabbit hole, right? So I'm not saying it's a bad thing. I'm just saying be aware that a lot of that isn't real growth potentially happening there. And a lot of businesses that should have gone out of business haven't. That's going to happen eventually. There's going to be a day of reckoning there. So I personally think stick with what you know, be good at what you do for a living, have some cash on hand for emergencies and so forth, and then put money into assets that you know about, care about, and control. Remember that a lot of the things that have been temporary, or we thought were temporary, are going to become permanent. So treat this whole change like it's permanent and invest in skills and abilities and people that are going to help you get through this, because much of it's going to stick. And the last thing I want to say is don't panic. A lot of people get scared by uncertainty. Don't let uncertainty drive your decisions. When we make decisions out of fear, we usually make bad decisions. So if this video has been valuable to you, go ahead and click the like button, subscribe. Love to have you join us. If you want to know a little bit more about inflation and how that goes, you can just click the video right here. I talk a little bit more in depth about inflation, what it is, how it might or might not work for you. And the other thing that I'll say is this. We're going to be in this for a little bit longer. I predict that this whole pandemic thing's going to happen at least and be prevalent at least until this summer. So take time, enjoy the experiences that you do have, spend time with loved ones, take advantage of what you can, even if it's over Zoom, spend time in the outdoors. There's going to be a lot of great memories made this year as long as you allow yourself to do it. Don't let the fear and uncertainty stop you from doing the things that are most important. That's my best advice for you. If you have questions, drop them in the comments below. Otherwise, love to see you on the next video, and we'll wishing you the best for 2021. Thank you.